So what I'm going to share with you now is how you calculate income tax and clear up a number of, a template, a blueprint, a number of misconceptions when it comes to income tax that a lot of CMAP students get confused with. And I've got 5 steps for you for this one. I love a bit of steps, don't you? Step number 1 is you want to calculate all of your income. That's the first thing you're going to do. You work out all your income. So, salary, dividends, profits from self-employment, rents from property, pension income, investments, interest from products that you've got invested in the bank. That's all of your income. Doesn't matter from wherever you get it from, self-employment, employment, whatever. It's all potentially taxable, and you've got to add it all up, and that's pretty much an easy thing to do. Now, there is a lot of tax-free income out there, which you need to be aware of. Some of the more popular ones in the exam syllabus are national savings. Some of the national savings interest is tax-free. ISAs are tax-free, aren't they? Lottery winnings are still tax-free. Who does the lottery anymore? Do you do the lottery? I haven't done the lottery for years. Some state benefits are tax-free. Redundancy payments up to a certain limit, they're all tax-free. So you need to be aware of some tax-free income, but the majority of income is then taxable. And that's your income, that's your salary, that's your gross income. Now don't use that figure, that's where a lot of people go wrong. Don't use that figure to work out your tax, because there's 2 things you need to take off first. The first one are your allowances. So number 2 then is less your allowances. Now allowances, I'll just put that up for you. You've come across many times before. Allowances are something that everybody in the UK is given, even when you're age 1. We've got a couple of kids next door, age 1 and 3, I think they are. They've got allowances as well, although they probably don't earn money to use it. Everybody has a personal allowance, you see, which you need to check in the tax sheet to see what that is. So, it's over 10 grand a year. It's a lot of money. It's tax-free income. So you deduct your allowance from your income. So the personal allowance is the big one. You've also got what they call the marriage allowance, which allows you to transfer 10% of your personal allowance to your spouse or civil partner. That's a good thing. You have a married couple's allowance, which is when you're really old and you can get a little bit of an additional allowance as well, because you're like really old. There's no reason, it's just political. There's also blind person's allowance, which gives you just that little bit more money, which is tax-free. You've also got the personal savings allowance as well, haven't you? The £1,000, £500 figure. That's an allowance against your savings income, and you have a dividend allowance as well, which allows you to have some dividends paid without tax. Again, the numbers, check it in the tax sheet. You don't need to remember them because they're all in the tax sheet, but you have to deduct the allowances. That's easy peasy lemon squeezy. Number 3, and this is one that not a lot of people are aware of, is you then have to deduct your deductions. This is what we call it, deductions. Now, deductions are just small things really, which further reduce your income before you start slapping the tax on. Now, the big one is pension contributions to an employer's scheme, where you pay it through your salary. Now, my partner Shelley used to work for a company which she was in a company pension scheme, and she'd have a pension contribution that she paid taken off of her salary, pretty much as a deduction before she was taxed. That's quite a common one, isn't it? Some charitable donations work in the same way. You can also have things that you bought that are wholly and exclusively used for business. Now, I remember a long time ago I tried to claim a pilot case. Now, when I became a trainer back in the 90s, this is before online, of course, we used to have to go into hotel rooms with all our kit. And I bought a load of these pilot cases because they look really cool. And these pilot cases had all my books and documents and slides and things before we had PowerPoint. And I used to walk around the country with these pilot cases. They were pretty expensive things, 50 quid a pop. So I tried to claim the cost of these from the HMRC. I don't think I was successful because they argued I could use them for other things. I said, well, what can I use a pilot case for outside of work? And we had this toing and froing, and in the end, they grind you down, don't they? So I didn't get any money taken off. So that's deductions. Now, once that's all done then, that then equals your taxable income. There we go, taxable income. Now you've got to be aware of this because that determines the rate of tax that you're going to pay. And people get confused by this. They tell me this, but it's your income, less allowances, less deductions gives you taxable income. And it's at that point, if we go on to step number 4, put it over here for you, is at that point then that you then apply the percentage bands. So here we have the percentage bands of tax. Now again, look at the tax sheet, see what they are. You'll have basic rate tax, you'll have, 25%, let's get this right. You'll have higher rate tax, there you go, let's scrub that out. Higher rate tax and additional rate tax. These percentages are based around certain bands. And that's when you start slapping the tax on the income, but you slap it against the taxable income, not your gross income. So that's easy peasy lemon squeeze there, isn't it? You break it down into slabs, and we've got videos which explain how that works. The last point to make, and I'll put this as number 5 there, is you've got to pay the tax, obviously. Now most people who are employed pay under the PAY system, pay as you earn. That broadly means that they have, each month their payroll department deducts tax from their income, so they don't have to pay any. And at the end of the year you get what's called a P60, which is a form which shares how much tax you've paid and what's your income been. Great for mortgage advisors, by the way, P60s and pay slips, because it tells you exactly how much people have earned. If you look at them closely, it's got all this kit in there as well. Some employed people also have to do a self-assessment. There you go, self-assessment. If they have income from other sources, maybe a rental income, or if they're high rate taxpayers, they may have to pay extra tax more than what the PAY is taken out. So self-assessment then is done for them as a means of just adding a bit more tax to their bill. That's employed people. Self-employed, very different altogether. Self-employed people, of course, make profits. Let's just squeeze them in down here. Self-employed. I'm not talking here about directors of limited companies. They are actually employed people. But a self-employed person, we've got a guy coming in this week to do some work to our bathroom. He runs a trade, he runs his own business, he's self-employed. Now he will do a self-assessment. So self-employed people do self-assessments in the same way as those guys. That's the only way they do their tax. They fill in their self-assessment online form, and then they pay their tax in 2 instalments in January and July. They're the 2 dates to remember. They have to pay them in advance now, so that they're paying estimates of next year's bill in January. So they're paying it in advance now, or as close as they can to when they've actually made the money. But broadly speaking, they pay it in 2 instalments, half in January and half in July. But in January they have to pay an extra according to next year's income as well. So they're paying double pretty much all the way through, which is fair enough. And that's how the self-employed pay their tax. Obviously the revenue have been quite nice to people recently. Self-employed, they let them postpone their July charge, I think, to this January. But they're all catching up with them now, aren't they? PAY people have had their income tax deducted all the way through. So that's how income tax works. That's the template for you. We've got videos which will give you examples of how it works, actual calculations. But I tell you what, is a little secret for you. Most exam questions in CMAP only really tend to get your understanding of this kit. You don't actually get many calculation questions in the exam, but not a lot of people know that. They get really worried about calculating tax, but there's very few questions, if any, on actually how to calculate it. This understanding is more important, because as a mortgage advisor, you need to know that it's the taxable income that determines the tax rate. It's the tax rate that determines various products you're going to recommend. The old tax tail wagging the investment dog. Hope that's been useful for you.